So in the last video, we discussed balance sheet, the purpose of it and the ins and outs of it and how to do that. I thought it would be a good idea for us to go through one, just like income statement, and analyze it a little bit, discuss it. Think of it as very conversational. We're just going through a sample one. This one is based on categories, so each one can have subcategories. I'll explain it in a bit. And we have our new business. TikTok gurus industries failed, unfortunately. I didn't make enough videos. But we're back in hospitality, Uncle PZ Persian Food. We're here to serve you with all your Persian food needs. On to the asset section. We have our current assets. As you can see, we discussed what is current assets: assets that are liquid, meaning cash, or can be liquidated within a year or less. So cash or cash equivalent. Cash or something that can be turned in cash fairly fast. So we have cash. Again, this can be subcategorized into specifics. For example, if you have $30,000 in the Wells Fargo checking account and $5,000 in the Wells Fargo savings account, though I don't recommend you going to Wells Fargo for anything, so avoid Wells Fargo, but this is how it can be categorized. And next one is accounts receivable. We discussed that. Let's say that you did something for a company. They said, hey, we want to have a lunch meeting, or we want to have an event here. So what you do is you provided that event to them, you provided the food, or there's a company tab open that they just come in, they buy foods and drinks, they order takeouts, and they say, hey, put it on my tab. At the end of the month, we'll pay you back. Or if you have an arrangement with them, this could be your accounts receivable, meaning you have $21,000 of services you rendered, $21,000 worth of revenue you accrued on an accrual basis, if you remember an income statement video, but you haven't gotten that in cash yet. But it is your asset, it is your receivable. You earned that money, you incurred some expenses with that, you bought supplies for that, you provided food and drink for that. So it's fair that you can have it as an asset there. So in our accounting system, in GAAP at least, and IFRS too, we recognize that it's your asset. Next up is inventory. That's your supplies, the food, the liquor, the things that you have in hand. Usually from business to business is different. We're doing it in a context of our Persian restaurant. So our inventory is mostly food items, onions, carrots, meat, poultry, things like that, fish, and liquor. The inventory is big. That's why we have a lot of it. $3,200 of inventory. A lot of liquors, wines, and things like that we have is also part of our inventory as well. So for your business, it's very important that you have a really good inventory record keeping, so you'll know how much you have. Next one is prepaid expenses. An example for that would be insurance expense. Let's say that I have a liability insurance that I have to purchase, and usually the company would say, hey, if you pay for the whole year upfront, you can have 20% off. We'll say, well, not a bad idea. 20% savings, let's just pay it. So that's prepaid expense. You prepaid your expense for the whole year in the beginning of the year. The other one is if you bought some premium cable package and from Xfinity, and Xfinity says, hey, if you pay for the whole year, you get 10% off. You're like, yeah, not a bad deal. We want to have UFC on, we want to have some sports on, we want to have football on, and so on. So let's buy that prepaid package, the prepaid premium package, and that's your prepaid expense. So we have $4,800 of prepaid expense. This would be prepaid insurance, plus cable, and so on. So we paid for the whole year, but that hasn't been incurred yet. So we get to have it as an asset because that's a cash we gave out to a vendor for a service that they're going to give us month after month for the rest of the year. So that's it. That'll conclude our current assets. We have $64,000 in current assets, and we'll evaluate to see if it's good enough, if it's enough to pay for our current liabilities. But before we go to liabilities, we have fixed assets or long-term assets. These are all mostly operational assets. Machinery and equipment, $68,000. Why is it so high? It's just because our business needs are very heavily tied to them. These are our grills, outdoor grills, convection oven, built-in fridge, built-in freezer, things like that. So you have those are pretty expensive. Those kind of machineries and equipments they add up, they're very expensive, and we own all of them. Some businesses, hospitality, they can lease them, but for our company, we own them. So it's $68,000. That is the total value of it at the moment. So we have it on our balance sheet. The other one is furniture and fixture. That's your couch, chairs, tables, things like that. And that's very simple. We have $6,000 worth of them there. And again, in real life accounting, furniture and fixtures are subcategorized by chairs, dining chairs, bar stools, tables, things like that, or like the welcome booth. Another one, which is very important, and it's something that you should know about for starting your own business that needs a commercial spacing, like a retail store or a hospitality, is leasehold improvements. So what is leasehold improvements? When you are renting a commercial unit, it's not like residential where you have the appliance there, where the unit is built at, all you do is bring your furniture and you just move in. For commercial properties, it's essentially a blank canvas. So as a landlord, we're expected to give you a fresh coat of paint, flooring that's concrete usually, that's leveled out, change the ceiling tiles, change the baseboard, change the trims, and make the unit look good. And again, some of the things like electrical and plumbing and HVAC should work, even though as a commercial tenant, you have to have a HVAC maintenance contract for the total duration of your stay. So if you're a restaurant or a retail store, you have to actually go into this unit and spend a ton of money building it out the way you want it. For example, if you have a bar or restaurant, you might have units designated or the architecture that allows you to build in a kitchen and a bar section and a dining section, but you have to pay an architect contractor to come in and build it in for you. So it's a lot of money. One example with our property is that we rented out to a brewery. It was a kind of a nice looking industrial brewery idea, but they came in and all we did was we gave it a fresh coat of paint. We made sure the flooring is okay. We changed out the baseboards, we changed out the trims, and we changed the ceiling tiles. But the unit was ready for them to move in and do whatever they wanted. So what they did is they hired an architect, they hired a contractor, they built out a kitchen in the back. They built a bar space. They built a new bathroom section. They built a warehouse for their brewing towers or brewing machines and things like that. So they put it in the back. They added a roll-up door. But in the lease, we were responsible for the roll-up door, which is the industrial aluminum roll-up doors that is in the back of the unit so they can have deliveries coming into the warehouse. But everything else was on them. So that's the leasehold improvements. You spent a lot of money making the unit the way that you wanted to. That money is not going to waste. It's an asset of yours. And we spent $35,000, which is actually on the low end of these, to move into our Persian restaurant. So we can cook food, we can serve customers, we can get our permits, we can get the certificate of occupancy, and we can just be there and operate as a business in the eye of the state and the county. Next one is $35,000 in land and buildings. Obviously, we don't own the building we're operating out of, but we decided to buy land, that's very cheap land, down here in Florida, $35,000 to build out our own second branch there, which is a great plan that we have. We're gonna save money for that, but we built the land because market is hot. We wanted to have the land there. We love the location. It's in the community that we love. But slowly but surely, we're going to build our second location. Until then, we have this land as an asset in our books. And last is the 45,000 other fixed assets that can be categorized as different things that weren't in any of those categories. For us is in a little nice van that we bought to do delivery ourselves. We're anti-Uber Eats. We don't like these delivery apps. We want to do it our own. We have an online ordering system on our website. We're using that van to go out there and deliver to our communities. But we got a sweetheart deal for $45,000, which is pretty good today for a commercial van, but we have that as well. We'll have it in our books. Last part of our assets, which is very important here, is intangible assets. We explain tangible assets are the assets that we can see, feel, touch, and so on. But intangible assets, even though we can feel, see, or touch, they are our assets. They add value to our business. They are added value to our operations, so we have to have it in our books as well. And again, if you watch the previous video, there are a ton of examples, there are a ton of categories that it can have. For us, we have a goodwill because we're very close to our communities. We do a lot of community outreach, local news writes about us. We're involved in a lot of charities and so on. We have strong ties to our local business community. Therefore, there's a goodwill that our business built, which is Uncle Peasy Persian Food LLC. Well, don't think about stealing that because that's trademark. Even our logo, which is secret for now, is trademarked too. So we have $3,500 value on it. The way you calculate it is different. It's usually cost of acquire plus scarcity and so on. It can be very subjective, but for us, it's worth $3,500. That brings our total asset to $266,500. Is it good? Is it bad? We don't know. We have to do more analysis. But we go to our liabilities. Current liabilities, we have things like accounts payable. This is usually when your supplier brings you a lot of ingredients, alcohol, and so on, and they send you a bill or they have the bill uploaded to your portal. When you go and pay it, this can be resolved. But for us, because it's always revolving, we always have suppliers bring us food. And in restaurant business and retail, it's not like you can plan it. Sometimes you need things very fast. You need a lot of meat, a lot of poultry, a lot of fish. So you order it. And so on a revolving basis, you're always going to have some sort of accounts payable. or the bills that you owe your other vendors, they go here. Another example is that if you have a plumber or electrician came in and did some work for your unit that you're responsible for and you're yet to pay, it goes there as well. So think of accounts payable as any type of vendor or services that was rendered to you but you haven't paid for it. Another one is interest payable. We discussed that before. The loan that we took, we have a working capital loan, also a long-term bank loan. This is the interest that we have to pay for that. So those are the principal amounts. We have to categorize interest in 12,000 as well. I know for taxation and compliance, interest expense in income statement has very specific tax considerations, so we want to separate them as well. Next one that might be a little foreign to is unearned revenue. What is unearned revenue? What is revenue doing in liabilities? Isn't revenue a good thing? Well, it's different. Unearned revenue is when you got paid for a service that you haven't rendered or a product that you haven't delivered. In our restaurant, we have a wedding. So we gave a quote for this wedding for $6,000. And we said, we'll prepare the space for you. We'll cook the food. We have the wine. We have the liquor. We have Andy coming and sing for us. So we fixed up everything. Maybe we have Evie come in and sing for us. Who knows? But we'll have all that prepared. But give us half of it upfront. Give us $3,000 upfront. And then once we finish the event, we had the wedding night, it's all wrapped up, give us another check for $3,000. So what happened is that you got $3,000 that's in your bank account that you haven't rendered that service for. So it's an unearned revenue. The moment you render those services, you have the food, you have the thing, the wedding is done, you earn that revenue plus another $3,000. But for now, since you're preparing for that event, you have $3,000 in your books that you haven't earned. It's still a liability. Why is it a liability? Because in order for you to render that service, you still have to go through some expenses. You still have to make some money, put some effort to satisfy that request. So it is a liability because you were paid some money to satisfy a need of your customer that you haven't done so. So until you do that, it's a liability. Working capital loan, as I explained, we wanted some cash flow help. We wanted some revolving cash flow for our business. So we went to our trusted lender and said, hey, can we get $25,000 worth of working capital loan? And they said, oh, absolutely. Come on here, apply and get it. So this is the principal amount that we owe. It's less than 12 months amortized. So we have to pay it back in like 6 months or 5 months. So it's in our books for current liabilities. Another one is current part of long-term debt. If you have a long-term debt, you have a balance, the principal amount for the total amount. What happens is that we have to deduct the part that we have to satisfy this year and put it in our current liabilities. The rest, which will be amortized or matured in the future, will be in the long-term section. So now we're in the long-term section and we see something that is bank loans payable, $164,000. This is the SBA loan we got to open our business, lease the place, add a lot of leasehold improvements, buy a lot of our machinery and equipment. If you can see down here, buy a lot of fixture and furniture, even buy our land full cash. So this was something that an SBA lender gave us. This is the principal. Obviously, 8,000 of it has to be paid this year, but 164,000 of it is for following years. This is, we like to think of it as a 5 to 10 year loan. So we have 5 to 10 years to pay this amount, but for this year, current year, we have to pay 8,000. And all we have is a $12,000 long-term debt, which is the $12,000 car loan we got out to pay for this nice little delivery truck. So we paid a good hefty little down payment in cash for the truck, but we borrowed 12,000 of it. And again, the cost of financing, the interest of it is included in this 12,000. This is a little bit unrealistic because based on the loans we got, interest payment, at least for the car loan and the working capital, is very low, but that's the interest we have to pay this year. Again, as years go by, as more interest gets incurred, we have to keep paying interest. So that SBA, the total cost of this SBA is not 12,000 or is not included in this 12,000. Is way more, but it gets incurred to us year after year. So we see that actually our total liabilities are 239,000, which is not a bad news because your total assets are sitting at 266,500. So your head is above the water barely. That means that you have a bit of a margin where your assets are more than your liabilities. It's a good news because that means that you're not over leveraged to the point that the amount of money that you owe goes beyond what you own, which is a bad news if that happens. But since you have more assets than liabilities, you have some sort of equity, and that equity, total equity, equals 27,500. Again, 27,500, where do they come from? It's a function. It's a function of total assets minus total liabilities. So this is 27,500. Again, this can be categorized in different categories as well. For example, our general partner, let's say for example me, well, I own more capital for the company. I own $12,000 of it in my capital, in my share of ownership in the company. We have a limited partner who someone came into business with me through a partnership, and they own 8,000 of that equity as well. 7,500 of it is the retained net income that we got from last year. This is a private company. We don't have any shareholder dividends. We don't give out dividends, or we don't even give out ownership payouts. So everything that we retained from last year comes into our books this year, which is 7,500 as well. The math, the beauty of it is that everything should balance. So now your retained earnings plus partner's equity should equal to your total shareholder equity, and your shareholder equity or owner's equity plus total liabilities should equal your assets. And that's what we call a balanced book. Meaning if you look at a scale and one side of it is your assets, the other is liabilities and shareholder equity, they have to be balanced. So that's why having a really good bookkeeper, really good CPA, or someone who actually understands these concepts is very important, because I have seen it. I have seen a lot of small business owners render the services of these bookkeeping services who are people who just learn how to use QuickBooks. And I request their income statement, I request their balance sheet, and sometimes what I get is an unbalanced balance sheet, that shouldn't happen. So be careful, make sure your books are in order, and you can have a bookkeeper, you can have a CPA, but you need to know how these look. You need to know how to analyze these. So learn them and make sure that you understand what are the building blocks of each. Well, thank you so much for watching. I appreciate it as always. Let me know in the comments what other things you want to talk about. If you're more interested in more of these small business resources or real estate investment, more than happy to make that for you. But don't forget to check out the income statement video where we explain the income statement right here. We did one for balance sheet. This is a follow-up to that video, so make sure you watch that here as well. If you like this deep dive after you watch the income statement, watch the deep dive for income statement as well. Here we did the same thing. We explained elements of each. That gives you a little bit more knowledge, a little bit more expertise on that. But other than that, thank you so much for watching. Love you all and keep learning. See you next time.